Good afternoon. This is your Money Show Market Wrap for the week ended September 15th. Oh, it's looking good for a while anyway, right? Stock surged on Thursday after SoftBank pulled off its mega IPO of the chip design company ARM Holdings. If we could just taken a siesta after the 3 days, then we'd be in the clear. But it wasn't meant to be. We gave back most of yesterday's gain today. It looks like we're going to have the dreaded and dull unch for the major indices this week. Gold and silver stocks fared well, though, as did banks. And oil continues to shine, up another 4% this week and 12% in the last month to around $91 a barrel for benchmark US crude. The economic front, it was a mixed bag. The biggest report of the week was CPI, and all the inflation numbers in it weren't terrible. They weren't great either. As for corporate news, we got the big, gala, huge, over the top annual iPhone announcement from Apple. But it's hard to get too riled up about a new charging port. During next week, we have a bunch of economic data from the housing sector, including the NAHB data and housing starts and permits. Many housing stocks have actually had a pretty great year despite higher mortgage rates. We've seen the pullback last few weeks, just again, based on some of the cumulative impact of those interest rate worries, and the broader market pullback. The big kahuna, of course, for next week is the Fed meeting set for Tuesday and Wednesday. As you can see here, rate futures markets are almost fully priced for no hike, with a 97% probability that policymakers will stand pat. But investors will be eager to hear what Chairman Jay Powell and co. have to say about the outlook for the rest of the year and beyond. We have two more meetings in 2023, one Fed meeting that ends on November 1st and one that ends on December 13th. The funds rate target is currently 5.25% to 5.5%. With that, I hope you had a great week in the markets. This is Mike Larson, editor-in-chief at Money Show, wishing you an enjoyable weekend. Thanks for tuning in.